If we look at the current situation in Europe, we can see that it is not good. Europe is in the midst of a Russian invasion of Ukraine. Falling consumer sentiment, rising inflation, rising energy bills, and the list goes on and on. These problems, along with many others, are making the situation worse. Before we dive in, kindly subscribe to the channel to be the first to know about Europe and its economy. Kindly hit the like button so that this video can get to other people. Russia's invasion of Ukraine. The sanctions imposed on Russia are raising the costs of replacing key military equipment and targeting key sectors of the Russian economy. These measures are also targeting Russian political elites, oligarchs, and their family members. These measures are aimed at drastically undermining Russia's ability to conduct monetary policy and control its sharp ruble depreciation. Although projections are based on limited data, it is clear that the war will have negative macroeconomic consequences. The World Bank's preliminary forecasts indicate that the Russian and Ukrainian economies will contract by nearly half and a third, respectively, by 2022. Further, global inflation is likely to increase by 1.3 percentage points. Moreover, global trade is likely to slow by 2.3 percentage points. As Russia's invasion of Ukraine drags on, sanctions will increase. A core focus of these sanctions will be on the Russian energy industry. The EU is heavily reliant on imported Russian energy. Russia has been using this energy to fund its military operations in Ukraine. While this may be a short-term strategy, it does suggest that Russia is willing to use energy leverage against Europe. Falling consumer sentiment. According to Morning Consult's Consumer Sentiment Index, consumer confidence in Europe has deteriorated significantly. This is particularly true in the United Kingdom, where the sentiment indicator fell by 10.1% from its July level. With inflation on the rise and the Bank of England aggressively tightening its monetary policy, the situation is far from rosy. Prices are one of the biggest worries of European consumers. The survey found that almost 5/4 of respondents said they have experienced price increases on goods they buy often or regularly. The survey also found that consumers' confidence levels in the European economy have fallen significantly in the last year. Consumers are increasingly pessimistic about the economy, with 43% describing themselves as pessimistic. The results suggest that many consumers in Europe are not planning to treat themselves in the next 3 months. Only a quarter plan to splurge this year. The decline in splurging has been accelerating since June, when 44% of consumers anticipated a treat. The trend has also accelerated in several countries. In Italy, for example, consumers are planning to spend 61% less than they did last year. And in the United Kingdom, the trend has increased by nearly 10 percentage points. Rising inflation. As the US and Europe grapple with rising costs and reduced demand, the term recession has increasingly appeared in economic forecasts. The Dutch bank ING recently reported that the composite PMI fell below the 50-point mark, indicating a contraction in business activity. The survey also suggests that this contraction began in the third quarter. Some economists are concerned about the impact of rising energy prices on the Eurozone economy. Some argue that the current energy crisis is only a short-term problem caused by the war in Ukraine, while others warn of a broader crisis. In any case, the economic consequences of rising energy prices are likely to exacerbate the already dire situation. Inflation in Europe is rising at a steady rate, with some regions being worse hit than others. Among the hardest hit are the Baltic countries. In October, Estonia had the highest core inflation rate in the Eurozone, with an annual rate of 22.4%, a staggering increase from 6.8% a year ago. Other countries like Lithuania and Latvia had high inflation rates of over 20%. Rising energy bills. Europe's energy prices are rising, and the recession that may result could be very deep. The high prices are hurting the average consumer and businesses. As a result, the energy industry has been slowing down and fewer companies are producing. A slowdown in this sector will reduce economic activity and increase unemployment. The recession could last until at least 2024. Several governments are trying to limit the impact of energy price hikes on their economies. They can introduce energy price caps to limit the impact, but the extra cost will hurt their budgets. In the UK, Prime Minister Liz Truss recently announced a package of measures to help consumers cope with the rising costs. The package would be worth about 6% to 8% of GDP and would require borrowing. A tipping possible recession. The energy crisis in Europe has pushed inflation to record levels and is squeezing households. The situation is only expected to get worse during the cold winter months, so efforts are underway to contain the damage. The European Central Bank and governments are employing crisis management strategies such as price caps and excess profits taxes. A recession in the euro area could present an opportunity for investors. While there is no certainty that Europe will enter a recession next year, a few factors make the possibility higher than normal. The war in Ukraine is a likely factor, as is the hawkish stance of the European Central Bank. The European Union's leading economic index has begun to deteriorate, which typically precedes a recession by 6 to 8 months. The OECD definition of a recession is 2 consecutive quarters of declining GDP. Banks are the culprits. Since the 2010 to 2011 global financial crisis, many European economies have been struggling with high debt and low economic growth. This problem is especially acute in the Eurozone, a group of 19 EU countries that use the euro currency. While not all of the countries within the Eurozone have been affected by the crisis, many neighboring countries have. These countries are highly indebted, with governments, banks, and corporations all battling for survival. Financial institutions in these countries have been holding back their reserves instead of lending out money, resulting in slow loan growth. This could have weighed on economic growth and made the crisis worse. In response to this, the ECB has attempted to inject capital into the financial system by buying government bonds. These actions have helped to stabilize the financial markets, but European policymakers have faced criticism for postponing a solution. Ultimately, this financial crisis has had huge political implications. In some countries, such as Greece, the push for austerity measures led to protests. In Portugal, government leaders were forced to resign. In Italy, meanwhile, the financial crisis led to the fall of the government. The crisis has largely been driven by the banking sector, which has become one of the major sources of financial instability in Europe. Bankruptcies in the banking sector can be particularly dangerous because they have a global reach and spread to other countries. The Great Recession of 2007-2009 began as a banking crisis, when Lehman Brothers went bankrupt.